The Most Important Thing. By Howard Marks. Uncommon Sense for the Thoughtful Investor. Chapter 1. The most important thing is second-level thinking. The art of investment has one characteristic that is not generally appreciated. A creditable, if unspectacular, result can be achieved by the lay investor with a minimum of effort and capability, but to improve this easily attainable standard requires much application and more than a trace of wisdom. Ben Graham, The Intelligent Investor. Everything should be made as simple as possible, but not simpler. Albert Einstein. It's not supposed to be easy. Anyone who finds it easy is stupid. Charlie Munger. Few people have what it takes to be great investors. Some can be taught, but not everyone. And those who can be taught can't be taught everything. Valid approaches work some of the time but not all. And investing can't be reduced to an algorithm and turned over to a computer. Even the best investors don't get it right every time. The reasons are simple. No rule always works. The environment isn't controllable, and circumstances rarely repeat exactly. Psychology plays a major role in markets, and because it's highly variable, cause and effect relationships aren't reliable. An investment approach may work for a while, but eventually the actions it calls for will change the environment, meaning a new approach is needed. And if others emulate an approach, that will blunt its effectiveness. Investing, like economics, is more art than science. And that means it can get a little messy. One of the most important things to bear in mind today is that economics isn't an exact science. It may not even be much of a science at all, in the sense that in science, controlled experiments can be conducted, past results can be replicated with confidence, and cause and effect relationships can be depended on to hold. Will it work? March 5, 2009. Because investing is at least as much art as it is science, it's never my goal, in this book or elsewhere, to suggest it can be routinized. In fact, one of the things I most want to emphasize is how essential it is that one's investment approach be intuitive and adaptive rather than be fixed and mechanistic. At bottom, it's a matter of what you're trying to accomplish. Anyone can achieve average investment performance. Just invest in an index fund that buys a little of everything. That will give you what is known as market returns, merely matching whatever the market does. But successful investors want more. They want to beat the market. In my view, that's the definition of successful investing, doing better than the market and other investors. To accomplish that, you need either good luck or superior insight. Counting on luck isn't much of a plan, so you'd better concentrate on insight. In basketball, they say, you can't coach height, meaning all the coaching in the world won't make a player taller. It's almost as hard to teach insight. As with any other art form, some people just understand investing better than others. They have, or manage to acquire, that necessary trace of wisdom that Ben Graham so eloquently calls for. Everyone wants to make money. All of economics is based on belief in the universality of the profit motive. So is capitalism. The profit motive makes people work harder and risk their capital. The pursuit of profit has produced much of the material progress the world has enjoyed. But that universality also makes beating the market a difficult task. Millions of people are competing for each available dollar of investment gain. Who'll get it? The person who's a step ahead. In some pursuits, getting to the front of the pack means more schooling, more time in the gym or the library, better nutrition, more perspiration, greater stamina, or better equipment. But in investing, where these things count for less, it calls for more perceptive thinking at what I call the second level. Would-be investors can take courses in finance and accounting, read widely and, if they are fortunate, receive mentoring from someone with a deep understanding of the investment process. But only a few of them will achieve the superior insight, intuition, sense of value and awareness of psychology that are required for consistently above average results. Doing so requires second-level thinking. Remember, your goal in investing isn't to earn average returns, you want to do better than average. Thus, your thinking has to be better than that of others, both more powerful and at a higher level. Since other investors may be smart, well-informed and highly computerized, you must find an edge they don't have. You must think of something they haven't thought of, see things they miss or bring insight they don't possess. You have to react differently and behave differently. In short, being right may be a necessary condition for investment success, but it won't be sufficient. You must be more right than others, which by definition means your thinking has to be different. What is second-level thinking? First-level thinking says, it's a good company, let's buy the stock. Second-level thinking says, it's a good company, but everyone thinks it's a great company, and it's not. So the stock's overrated and overpriced. Let's sell. First-level thinking says, the outlook calls for low growth and rising inflation. Let's dump our stocks. Second-level thinking says, the outlook stinks, but everyone else is selling in panic. Buy. First-level thinking says, I think the company's earnings will fall, sell. Second-level thinking says, I think the company's earnings will fall less than people expect, and the pleasant surprise will lift the stock, buy. First-level thinking is simplistic and superficial, and just about everyone can do it, a bad sign for anything involving an attempt at superiority. All the first-level thinker needs is an opinion about the future, as in, the outlook for the company is favorable, meaning the stock will go up. Second-level thinking is deep, complex and convoluted. The second-level thinker takes a great many things into account. What is the range of likely future outcomes? Which outcome do I think will occur? What's the probability I'm right? What does the consensus think? How does my expectation differ from the consensus? How does the current price for the asset comport with the consensus view of the future, and with mine? Is the consensus psychology that's incorporated in the price too bullish or bearish? What will happen to the asset's price if the consensus turns out to be right, and what if I'm right? The difference in workload between first-level and second-level thinking is clearly massive, and the number of people capable of the latter is tiny compared to the number capable of the former. First-level thinkers look for simple formulas and easy answers. Second-level thinkers know that success in investing is the antithesis of simple. That's not to say you won't run into plenty of people who try their darndest to make it sound simple. Some of them I might characterize as mercenaries. Brokerage firms want you to think everyone is capable of investing, at $10 per trade. Mutual fund companies don't want you to think you can do it, they want you to think they can do it. In that case, you'll put your money into actively managed funds and pay the associated high fees. Others who simplify are what I think of as proselytizers. Some are academics who teach investing. Others are well-intentioned practitioners who overestimate the extent to which they're in control. I think most of them fail to tote up their records, or they overlook their bad years or attribute losses to bad luck. Finally, there are those who simply fail to understand the complexity of the subject. A guest commentator on my drive time radio station says, if you have had good experience with a product, buy the stock. There's so much more than that to being a successful investor. First-level thinkers think the same way other first-level thinkers do about the same things, and they generally reach the same conclusions. By definition, this can't be the route to superior results. All investors can't beat the market since, collectively, they are the market. Before trying to compete in the zero-sum world of investing, you must ask yourself whether you have good reason to expect to be in the top half. To outperform the average investor, you have to be able to outthink the consensus. Are you capable of doing so? What makes you think so? The problem is that extraordinary performance comes only from correct non-consensus forecasts, but non-consensus forecasts are hard to make correctly and hard to act on. Over the years, many people have told me that the matrix shown below had an impact on them. You can't do the same things others do and expect to outperform. Unconventionality shouldn't be a goal in itself, but rather a way of thinking. In order to distinguish yourself from others, it helps to have ideas that are different and to process those ideas differently. I conceptualize the situation as a simple 2 by 2 matrix: conventional behavior, unconventional behavior, favorable outcomes, average good results above, average results, unfavorable outcomes, average bad results below, average results. Of course, it's not that easy and clear cut, but I think that's the general situation. If your behavior is conventional, you're likely to get conventional results, either good or bad. Only if your behavior is unconventional is your performance likely to be unconventional, and only if your judgments are superior is your performance likely to be above average. Dare to be great, September 7, 2006. The upshot is simple: to achieve superior investment results, you have to hold non-consensus views regarding value, and they have to be accurate. That's not easy. The attractiveness of buying something for less than it's worth makes eminent sense. So how is one to find bargains in efficient markets? You must bring exceptional analytical ability, insight or foresight. But because it's exceptional, few people have it. Returns and how they get that way, November 11, 2002. For your performance to diverge from the norm, your expectations, and thus your portfolio, have to diverge from the norm, and you have to be more right than the consensus. Different and better, that's a pretty good description of second-level thinking. Those who consider the investment process simple generally aren't aware of the need for, or even the existence of, second-level thinking. Thus, many people are misled into believing that everyone can be a successful investor. Not everyone can. But the good news is that the prevalence of first-level thinkers increases the returns available to second-level thinkers. To consistently achieve superior investment returns, you must be one of them. Chapter 2. The most important thing is understanding market efficiency and its limitations. In theory, there's no difference between theory and practice, but in practice there is. Yogi Berra. The 1960s saw the emergence of a new theory of finance and investing, a body of thought known as the Chicago School, because of its origins at the University of Chicago's Graduate School of Business. As a student there in 1967 to 1969, I found myself at ground zero for this new theory. It greatly informed and influenced my thinking. The theory included concepts that went on to become important elements in investment dialogue: risk aversion, volatility as the definition of risk, risk-adjusted returns, systematic and non-systematic risk, alpha, beta, the random walk hypothesis and the efficient market hypothesis. All of these are addressed in the pages that follow. In the years since it was first proposed, that last concept has proved to be particularly influential in the field of investing, so significant that it deserves its own chapter. The efficient market hypothesis states that there are many participants in the markets, and they share roughly equal access to all relevant information. They are intelligent, objective, highly motivated and hardworking. Their analytical models are widely known and employed. Because of the collective efforts of these participants, information is reflected fully and immediately in the market price of each asset. And because market participants will move instantly to buy any asset that's too cheap or sell one that's too dear, assets are priced fairly in the absolute and relative to each other. The market prices represent accurate estimates of assets' intrinsic value, and no participant can consistently identify and profit from instances when they are wrong. Assets therefore sell at prices from which they can be expected to deliver risk-adjusted returns that are fair relative to other assets. Riskier assets must offer higher returns in order to attract buyers. The market will set prices so that appears to be the case, but it won't provide a free lunch. That is, there will be no incremental return that is not related to, and compensatory for, incremental risk. That's a more or less official summary of the highlights. Now my take. When I speak of this theory, I also use the word efficient, but I mean it in the sense of speedy, quick to incorporate information, not right. I agree that because investors work hard to evaluate every new piece of information, asset prices immediately reflect the consensus view of the information's significance. I do not, however, believe the consensus view is necessarily correct. In January 2000, Yahoo sold at $237. In April 2001 it was at $11. Anyone who argues that the market was right both times has his or her head in the clouds. It has to have been wrong on at least one of those occasions. But that doesn't mean many investors were able to detect and act on the market's error. If prices in efficient markets already reflect the consensus, then sharing the consensus view will make you likely to earn just an average return. To beat the market you must hold an idiosyncratic, or non-consensus, view. The bottom line for me is that, although the more efficient markets often misvalue assets, it's not easy for any one person, working with the same information as everyone else and subject to the same psychological influences, to consistently hold views that are different from the consensus and closer to being correct. That's what makes the mainstream markets awfully hard to beat, even if they aren't always right. What's it all about, Alpha? July 11, 2001. The most important upshot from the efficient market hypothesis is its conclusion that you can't beat the market. Not only was this conclusion founded logically on the Chicago view of the market, but it was buttressed by studies of the performance of mutual funds. Very few of those funds have distinguished themselves through their results. What about the 5-star funds? You might ask. Read the small print. Mutual funds are rated relative to each other. The ratings don't say anything about their having beaten an objective standard such as a market index. Okay then, what about the celebrated investors we hear so much about? First, 1 or 2 good years prove nothing. Chance alone can produce just about any result. Second, statisticians insist nothing can be proved with statistical significance until you have enough years of data. I remember a figure of 60, for years. And almost no one manages money that long. Finally, the emergence of 1 or 2 great investors doesn't disprove the theory. The fact that the Warren Buffetts of this world attract as much attention as they do is an indication that consistent outperformers are exceptional. One of the greatest ramifications of the Chicago theory has been the development of passive investment vehicles known as index funds. If most active portfolio managers making active bets on which securities to overweight and underweight can't beat the market, why pay the price, in the form of transaction costs and management fees, entailed in trying? With that question in mind, investors have put growing amounts in funds that simply invest a market-determined amount in each stock or bond in a market index. In this way, investors enjoy market returns at a fee of just a few hundredths of a % per year. Everything moves in cycles, as I'll discuss later, and that includes accepted wisdom. So the efficient market hypothesis got off to a fast start in the 1960s and developed a lot of adherents. Objections have been raised since then, and the general view of its applicability rises and falls. I have my own reservations about the theory, and the biggest one has to do with the way it links return and risk. According to investment theory, people are risk-averse by nature. Meaning that in general they'd rather bear less risk than more. For them to make riskier investments, they have to be induced through the promise of higher returns. Thus, markets will adjust the prices of investments so that, based on the known facts and common perceptions, the riskier ones will appear to promise higher returns. Because theory says in an efficient market there's no such thing as investing skill, commonly referred to today as alpha, that would enable someone to beat the market, all the difference in return between one investment and another, or between one person's portfolio and another's, is attributable to differences in risk. In fact, if you show an adherent of the efficient market hypothesis an investment record that appears to be superior, as I have, the answer is likely to be, the higher return is explained by hidden risk. The fallback position is to say, you don't have enough years of data. Once in a while we experience periods when everything goes well and riskier investments deliver the higher returns they seem to promise. Those halcyon periods lull people into believing that to get higher returns, all they have to do is make riskier investments. But they ignore something that is easily forgotten in good times. This can't be true, because if riskier investments could be counted on to produce higher returns, they wouldn't be riskier. Every once in a while, then, people learn an essential lesson. They realize that nothing, and certainly not the indiscriminate acceptance of risk, carries the promise of a free lunch, and they're reminded of the limitations of investment theory. That's the theory and its implications. The key question is whether it's right. Is the market unbeatable? Are the people who try wasting their time? Are the clients who pay fees to investment managers wasting their money? As with most other things in my world, the answers aren't simple and they're certainly not yes or no. I don't believe the notion of market efficiency deserves to be dismissed out of hand. In principle, it's fair to conclude that if thousands of rational and numerate people gather information about an asset and evaluate it diligently and objectively, the asset's price shouldn't stray far from its intrinsic value. Mispricings shouldn't be regularly extant, meaning it should be hard to beat the market. In fact, some asset classes are quite efficient. In most of these, the asset class is widely known and has a broad following. The class is socially acceptable, not controversial or taboo. The merits of the class are clear and comprehensible, at least on the surface, and information about the class and its components is distributed widely and evenly. If these conditions are met, there's no reason why the asset class should systematically be overlooked, misunderstood, or underrated. Take foreign exchange, for example. What are the things that determine the movements of one currency versus another? Future growth rates and inflation rates. Is it possible for any one person to systematically know much more about these things than everyone else? Probably not. And if not, then no one should be able to regularly achieve above average risk-adjusted returns through currency trading. What about the major stock markets, such as the New York Stock Exchange? Here millions of people are prospecting, driven by the desire for profit. They're all similarly informed. In fact, it's one of the goals of our market regulation that everyone should gain access to the same company information at the same time. With millions of people doing similar analysis on the basis of similar information, how often will stocks become mispriced, and how regularly can any one person detect those mispricings? Answer: not often, and not dependably. But that is the essence of second-level thinking. Second-level thinkers know that, to achieve superior results, they have to have an edge in either information or analysis, or both. They are on the alert for instances of misperception. My son Andrew is a budding investor, and he comes up with lots of appealing investment ideas based on today's facts and the outlook for tomorrow. But he's been well trained. His first test is always the same, and who doesn't know that? In the vocabulary of the theory, second-level thinkers depend on inefficiency. The term inefficiency came into widespread use over the last 40 years as the counterpoint to the belief that investors can't beat the market. To me, describing a market as inefficient is a high-flown way of saying the market is prone to mistakes that can be taken advantage of. Where might errors come from? Let's consider the assumptions that underlie the theory of efficient markets. There are many investors hard at work. They are intelligent, diligent, objective, motivated, and well-equipped. They all have access to the available information, and their access is roughly equal. They're all open to buying, selling, or shorting, i.e., betting against every asset. For those reasons, theory says that all the available information will be smoothly and efficiently synthesized into prices and acted on whenever price/value discrepancies arise, so as to drive out those discrepancies. But it's impossible to argue that market prices are always right. In fact, if you look at the four assumptions just listed, 1 stands out as particularly tenuous: objectivity. Human beings are not clinical computing machines. Rather, most people are driven by greed, fear, envy, and other emotions that render objectivity impossible and open the door for significant mistakes. Likewise, what about the fourth assumption? Whereas investors are supposed to be open to any asset, and to both owning it and being short, the truth is very different. Most professionals are assigned to particular market niches, as in, I work in the equity department, or I'm a bond manager. And the percentage of investors who ever sell short is truly tiny. Who, then, makes and implements the decisions that would drive out relative mispricings between asset classes? A market characterized by mistakes and mispricings can be beaten by people with rare insight. Thus, the existence of inefficiencies gives rise to the possibility of outperformance and is a necessary condition for it. It does not, however, guarantee it. To me, an inefficient market is one that is marked by at least one, and probably, as a result, by all, of the following characteristics. Market prices are often wrong. Because access to information and the analysis thereof are highly imperfect, market prices are often far above or far below intrinsic values. The risk-adjusted return on one asset class can be far out of line with those of other asset classes. Because assets are often valued at other than fair prices, an asset class can deliver a risk-adjusted return that is significantly too high, a free lunch, or too low relative to other asset classes. Some investors can consistently outperform others. Because of the existence of significant misvaluations and differences among participants in terms of skill, insight, and information access, it is possible for misvaluations to be identified and profited from with regularity. This last point is very important in terms of what it does and does not mean. Inefficient markets do not necessarily give their participants generous returns. Rather, it's my view that they provide the raw material, mispricings, that can allow some people to win and others to lose on the basis of differential skill. If prices can be very wrong, that means it's possible to find bargains or overpay. For every person who gets a good buy in an inefficient market, someone else sells too cheap. One of the great sayings about poker is that, in every game there's a fish. If you've played for 45 minutes and haven't figured out who the fish is, then it's you. The same is certainly true of inefficient market investing. What's it all about, Alpha? July 11, 2001. In the great debate over efficiency versus inefficiency, I have concluded that no market is completely one or the other. It's just a matter of degree. I wholeheartedly appreciate the opportunities that inefficiency can provide, but I also respect the concept of market efficiency, and I believe strongly that mainstream securities markets can be so efficient that it's largely a waste of time to work at finding winners there. In the end, I've come to an interesting resolution: efficiency is not so universal that we should give up on superior performance. At the same time, efficiency is what lawyers call a rebuttable presumption, something that should be presumed to be true until someone proves otherwise. Therefore, we should assume that efficiency will impede our achievement unless we have good reason to believe it won't in the present case. Respect for efficiency says that before we embark on a course of action, we should ask some questions. Have mistakes and mispricings been driven out through investors' concerted efforts, or do they still exist, and why? Think of it this way: why should a bargain exist despite the presence of thousands of investors who stand ready and willing to bid up the price of anything that's too cheap? If the return appears so generous in proportion to the risk, might you be overlooking some hidden risk? Why would the seller of the asset be willing to part with it at a price from which it will give you an excessive return? Do you really know more about the asset than the seller does? If it's such a great proposition, why hasn't someone else snapped it up? Something else to keep in mind: just because efficiencies exist today doesn't mean they'll remain forever. Bottom line, inefficiency is a necessary condition for superior investing. Attempting to outperform in a perfectly efficient market is like flipping a fair coin. The best you can hope for is 50-50. For investors to get an edge, there have to be inefficiencies in the underlying process, imperfections, mispricings, to take advantage of. But let's say there are. That alone is not a sufficient condition for outperformance. All that means is that prices aren't always fair and mistakes are occurring. Some assets are priced too low and some too high. You still have to be more insightful than others in order to regularly buy more of the former than the latter. Many of the best bargains at any point in time are found among the things other investors can't or won't do. Let others believe markets can never be beat. Abstention on the part of those who won't venture in creates opportunities for those who will. Is investment theory, with its notion of market efficiency, the equivalent of a physical law that is universally true? Or is it an irrelevant ivory tower notion to be disregarded? In the end, it's a question of balance, and balance comes from applying informed common sense. The key turning point in my investment management career came when I concluded that because the notion of market efficiency has relevance, I should limit my efforts to relatively inefficient markets where hard work and skill would pay off best. Theory informed that decision and prevented me from wasting my time in the mainstream markets, but it took an understanding of the limits of the theory to keep me from completely accepting the arguments against active management. In short, I think theory should inform our decisions but not dominate them. If we entirely ignore theory, we can make big mistakes. We can fool ourselves into thinking it's possible to know more than everyone else and to regularly beat heavily populated markets. We can buy securities for their returns but ignore their risk. We can buy 50 correlated securities and mistakenly think we've diversified. But swallowing theory whole can make us give up on finding bargains, turn the process over to a computer and miss out on the contributions skillful individuals can make. The image here is of the efficient market-believing finance professor who takes a walk with a student. "Isn't that a $10 bill lying on the ground?" asks the student. "No, it can't be a $10 bill," answers the professor. "If it were, someone would have picked it up by now." The professor walks away, and the student picks it up and has a beer. What's it all about, Alpha? July 11, 2001. Chapter 3. The most important thing is value. For investing to be reliably successful, an accurate estimate of intrinsic value is the indispensable starting point. Without it, any hope for consistent success as an investor is just that, hope. The oldest rule in investing is also the simplest: buy low, sell high. Seems blindingly obvious. Who would want to do anything else? But what does that rule actually mean? Again, obvious. On the surface, it means that you should buy something at a low price and sell it at a high price. But what, in turn, does that mean? What's high, and what's low? On a superficial level, you can take it to mean that the goal is to buy something for less than you sell it for. But since your sale will take place well down the road, that's not much help in figuring out the proper price at which to buy today. There has to be some objective standard for high and low, and most usefully that standard is the asset's intrinsic value. Now the meaning of the saying becomes clear: buy at a price below intrinsic value, and sell at a higher price. Of course, to do that, you'd better have a good idea what intrinsic value is. 4. An accurate estimate of value is the indispensable starting point. To simplify, or oversimplify, all approaches to investing in company securities can be divided into two basic types: those based on analysis of the company's attributes, known as fundamentals, and those based on study of the price behavior of the securities themselves. In other words, an investor has two basic choices: gauge the security's underlying intrinsic value and buy or sell when the price diverges from it, or base decisions purely on expectations regarding future price movements. I'll turn to the latter first, since I don't believe in it and should be able to dispose of it rather promptly. Technical analysis, or the study of past stock price behavior, has been practiced ever since I joined the industry, and well before that, but it's been in decline. Today, observations about historic price patterns may be used to supplement fundamental analysis, but we hear far less than we did in the past about people basing decisions primarily on what price movements tell them. Part of the decline of technical analysis can be attributed to the random walk hypothesis, a component of the Chicago theory developed in the early 1960s, primarily by Professor Eugene Fama. The random walk hypothesis says a stock's past price movements are of absolutely no help in predicting future movements. In other words, it's a random process, like tossing a coin. We all know that even if a coin has come up heads 10 times in a row, the probability of heads on the next throw is still 50-50. Likewise, the hypothesis says, the fact that a stock's price has risen for the last 10 days tells you nothing about what it will do tomorrow. Another form of relying on past stock price movements to tell you something is so-called momentum investing. It, too, exists in contravention of the random walk hypothesis. I'm unlikely to do it justice. But as I see it, investors who practice this approach operate under the assumption that they can tell when something that has been rising will continue to rise. Momentum investing might enable you to participate in a bull market that continues upward, but I see a lot of drawbacks. One is based on economist Herb Stein's wry observation that, if something cannot go on forever, it will stop. What happens to momentum investors then? How will this approach help them sell in time to avoid a decline? And what will it have them do in falling markets? It seems clear that momentum investing isn't a cerebral approach to investing. The greatest example came in 1998 to 1999, with the rise of people called day traders. Most were non-professional investors drawn from other walks of life by the hope for easy money in the tech, media, telecom stock boom. They rarely held positions overnight, since doing so would require them to pay for them. Several times a day, they would try to guess whether a stock they'd been watching would rise or fall in the next few hours. I've never understood how people reach conclusions like these. I liken it to trying to guess whether the next person to come around the corner will be male or female. The way I see it, day traders considered themselves successful if they bought a stock at $10 and sold at $11, bought it back the next week at $24, and sold at $25, and bought it a week later at $39 and sold at $40. If you can't see the flaw in this, that the trader made $3 in a stock that appreciated by $30, you probably shouldn't read the rest of this book. Moving away from momentum investors and their Ouija boards, along with all other forms of investing that eschew intelligent analysis, we are left with two approaches, both driven by fundamentals: value investing and growth investing. In a nutshell, value investors aim to come up with a security's current intrinsic value and buy when the price is lower, and growth investors try to find securities whose value will increase rapidly in the future. To value investors, an asset isn't an ephemeral concept you invest in because you think it's attractive, or think others will find it attractive. It's a tangible object that should have an intrinsic value capable of being ascertained, and if it can be bought below its intrinsic value, you might consider doing so. Thus, intelligent investing has to be built on estimates of intrinsic value. Those estimates must be derived rigorously, based on all of the available information. The most important thing, July 1, 2003. What is it that makes a security, or the underlying company, valuable? There are lots of candidates, financial resources, management, factories, retail outlets, patents, human resources, brand names, growth potential and, most of all, the ability to generate earnings and cash flow. In fact, most analytical approaches would say that all those other characteristics, financial resources, management, factories, retail outlets, patents, human resources, brand names and growth potential are valuable precisely because they can translate eventually into earnings and cash flow. The emphasis in value investing is on tangible factors like hard assets and cash flows. Intangibles like talent, popular fashions and long-term growth potential are given less weight. Certain strains of value investing focus exclusively on hard assets. There's even something called net investing, in which people buy when the total market value of a company's stock is less than the amount by which the company's current assets, such as cash, receivables and inventories, exceed its total liabilities. In this case, in theory, you could buy all the stock, liquidate the current assets, pay off the debts, and end up with the business and some cash. Pocket cash equal to your cost, and with more left over you'll have paid less than nothing for the business. The quest in value investing is for cheapness. Value investors typically look at financial metrics such as earnings, cash flow, dividends, hard assets and enterprise value and emphasize buying cheap on these bases. The primary goal of value investors, then, is to quantify the company's current value and buy its securities when they can do so cheaply. Growth investing lies somewhere between the dull plodding of value investing and the adrenaline charge of momentum investing. Its goal is to identify companies with bright futures. That means by definition that there's less emphasis on the company's current attributes and more on its potential. The difference between the two principal schools of investing can be boiled down to this: value investors buy stocks, even those whose intrinsic value may show little growth in the future, out of conviction that the current value is high relative to the current price. Growth investors buy stocks, even those whose current value is low relative to their current price, because they believe the value will grow fast enough in the future to produce substantial appreciation. Thus, it seems to me, the choice isn't really between value and growth, but between value today and value tomorrow. Growth investing represents a bet on company performance that may or may not materialize in the future, while value investing is based primarily on analysis of a company's current worth. The Happy Medium, July 21, 2004. It would be convenient to say that adherence to value investing permits investors to avoid conjecture about the future and that growth investing consists only of conjecture about the future, but that would be a considerable exaggeration. After all, establishing the current value of a business requires an opinion regarding its future, and that in turn must take into account the likely macroeconomic environment, competitive developments and technological advances. Even a promising net investment can be doomed if the company's assets are squandered on money-losing operations or unwise acquisitions. There's no bright line distinction between value and growth, both require us to deal with the future. Value investors think about the company's potential for growth, and the growth at a reasonable price school pays explicit homage to value. It's all a matter of degree. However, I think it can fairly be said that growth investing is about the future, whereas value investing emphasizes current-day considerations but can't escape dealing with the future. For an extreme example of growth investing, let me take you back to the days of the Nifty 50, a fad that epitomized the contrast with value investing and demonstrates how far a growth mania can go. In 1968, I had my first job in the investment management industry, as a summer employee in the investment research department of First National City Bank, now Citibank. The bank followed an approach known as Nifty 50 investing. Its goal was to identify the companies with the brightest outlook for earnings growth over the long term. In addition to growth rate, the bank's investment managers stressed quality, by which they meant a high probability that the growth expectations would be realized. It was official dictum that if a company was growing fast enough and of sufficient quality, the price paid for the stock didn't matter. If a stock is expensive based on today's metrics, give it a few years and it'll grow into its price. Then, as now, growth stock portfolios were heavily weighted toward drugs, technology and consumer products. The bank's portfolios included highly respected names such as IBM, Xerox, Kodak, Polaroid, Merck, Eli Lilly, Avon, Coca-Cola, Philip Morris, Hewlett-Packard, Motorola, Texas Instruments and Perkin-Elmer, America's great companies, all with bright outlooks for growth. Since nothing could go wrong at these companies, there was no hesitance to pay up for their stocks. Fast forward a couple of decades, and what do you see in that list of companies? Some, such as Kodak and Polaroid, have seen their basic businesses decimated by unforeseen changes in technology. Others, such as IBM and Xerox, became slow-moving prey on which new competitors feasted. All told, First National City's list of America's best companies has been visited by deterioration and even bankruptcy in the 42 years since I started. So much for the long term. Persistence of growth, and for the ability to predict it accurately. Compared to value. Growth investing centers around trying for big winners. If big winners weren't in the offing, why put up with the uncertainty entailed in guessing at the future? There's no question about it, it's harder to see the future than the present. Thus, the batting average for growth. Investors should be lower, but the payoff for doing it well might be higher. The return for correctly predicting which companies will come up with the best new drug, most powerful computer or best-selling movies should be substantial. In general, the upside potential for being right about growth is more dramatic, and the upside potential for being right about value is more consistent. Value is my approach. In my book, Consistency Trumps Drama. If value investing has the potential to consistently produce favorable results, does that mean it's easy? No. For one thing, it depends on an accurate estimate of value. Without that, any hope for consistent success as an investor is just that, hope. Without accurate estimates, you'll be as likely to overpay as to underpay. And if you overpay, it takes a surprising improvement in value, a strong market or an even less discriminating buyer, what we used to call a greater fool, to bail you out. There's more. If you've settled on the value approach to investing and come up with an intrinsic value for a security or asset, the next important thing is to hold it firmly. That's because in the world of investing, being correct about something isn't at all synonymous with being proved correct right away. It's hard to consistently do the right thing as an investor. But it's impossible to consistently do the right thing at the right time. The most we value investors can hope for is to be right about an asset's value and buy when it's available for less. But doing so today certainly doesn't mean you're going to start making money tomorrow. A firmly held view on value can help you cope with this disconnect. Let's say you figure out that something's worth 80 and have a chance to buy it for 60. Chances to buy well below actual value don't come along every day, and you should welcome them. Warren Buffett describes them as buying dollars for 50 cents. So, you buy it and you feel you've done a good thing. But don't expect immediate success. In fact, you'll often find that you've bought in the midst of a decline that continues. Pretty soon you'll be looking at losses. And as one of the greatest investment adages reminds us, being too far ahead of your time is indistinguishable from being wrong. So now that security worth 80 is priced at 50 instead of 60. What do? We learn in Microeconomics 101 that the demand curve slopes downward to the right. As the price of something goes up, the quantity demanded goes down. In other words, people want less of something at higher prices and more of it at lower prices. Makes sense, that's why stores do more business when goods go on sale. It works that way in most places, but far from always, it seems, in the world of investing. Many people tend to fall further in love with the thing they've bought as its price rises, since they feel validated, and they like it less as the price falls. When they begin to doubt their decision to buy. This makes it very difficult to hold, and to buy more at lower prices, which investors call averaging down, especially if the decline proves to be extensive. If you liked it at 60, you should like it more at 50, and much more at 40 and 30. But it's not that easy. No one's comfortable with losses, and eventually any human will wonder, maybe it's not me who's right. Maybe it's the market. The danger is maximized when they start to think, it's down so much, I'd better get out before it goes to zero. That's the kind of thinking that makes bottoms and causes people to sell there. Investors with no knowledge of, or concern for, profits, dividends, valuation, or the conduct of business simply cannot possess the resolve needed to do the right thing at the right time. With everyone around them buying and making money, they can't know when a stock is too high and therefore resist joining in. And with a market in freefall, they can't possibly have the confidence needed to hold or buy at severely reduced prices. Irrational exuberance, May 1st. 2000. An accurate opinion on valuation, loosely held, will be of limited help. An incorrect opinion on valuation, strongly held, is far worse. This one statement shows how hard it is to get it all right. Give most investors, and certainly most amateur investors, a dose of truth serum, and then ask this question: what's your approach to investing? The inevitable answer: I look for things that will go up. But the serious pursuit of profit has to be based on something more tangible. In my view, the best candidate for that something tangible is fundamentally derived intrinsic value. An accurate estimate of intrinsic value is the essential foundation for steady, unemotional, and potentially profitable investing. Value investors score their biggest gains when they buy an underpriced asset, average down unfailingly, and have their analysis proved out. Thus, there are two essential ingredients for profit in a declining market: you have to have a view on intrinsic value, and you have to hold that view strongly enough to be able to hang in and buy even as price decline suggests that you're wrong. Oh yes, there's a third: you have to be right. Chapter 4. The most important thing is the relationship between price and value. Investment success doesn't come from buying good things, but rather from buying things well. Let's say you've become convinced of the efficacy of value investing and you're able to come up with an estimate of intrinsic value for a stock or other asset. Let's even say your estimate is right. You're not done. In order to know what action to take, you have to look at the asset's price relative to its value. Establishing a healthy relationship between fundamentals, value, and price is at the core of successful investing. For a value investor, price has to be the starting point. It has been demonstrated time and time again that no asset is so good that it can't become a bad investment if bought at too high a price. And there are few assets so bad that they can't be a good investment when bought cheap enough. When people say flatly, we only buy A, or A is a superior asset class, that sounds a lot like, we buy A at any price and we buy it before B, C, or D at any price. That just has to be a mistake. No asset class or investment has the birthright of a high return. It's only attractive if it's priced right. Hopefully, if I offered to sell you my car, you'd ask the price before saying yes or no. Deciding on an investment without carefully considering the fairness of its price is just as silly. But when people decide without disciplined consideration of valuation that they want to own something, as they did with tech stocks in the late 1990s, or that they simply won't own something, as they did with junk bonds in the 1970s and early 1980s, that's just what they're doing. Bottom line, there's no such thing as a good or bad idea regardless of price. The most important thing, July 1, 2003. It's a fundamental premise of the efficient market hypothesis, and it makes perfect sense, that if you buy something for its fair value, you can expect a return that is fair given the risk. But active investors aren't in it for fair risk-adjusted returns, they want superior returns. If you'll be satisfied with fair returns, why not invest passively in an index fund and save a lot of trouble? So buying something at its intrinsic value is no great shakes. And paying more than something's worth is clearly a mistake. It takes a lot of hard work or a lot of luck to turn something bought at a too high price into a successful investment. Remember the Nifty 50 investing I described in the last chapter? At their highs, many of those stalwart companies sported price-earnings ratios, the ratio of the stock's price to the earnings behind each share, between 80 and 90. For comparison, the post-war average price-earnings ratio for stocks in general has been in the mid-teens. None of their partisans appeared to be worried about those elevated valuations. Then, in just a few years, everything changed. In the early 1970s, the stock market cooled off, exogenous factors like the oil embargo and rising inflation clouded the picture and the Nifty 50 stocks collapsed. Within a few years, those price-earnings ratios of 80 or 90 had fallen to 8 or 9, meaning investors in America's best companies had lost 90% of their money. People may have bought into great companies, but they paid the wrong price. At Oaktree we say, well bought is half sold. By this we mean we don't spend a lot of time thinking about what price we're going to be able to sell a holding for, or when, or to whom, or through what mechanism. If you've bought it cheap, eventually those questions will answer themselves. If your estimate of intrinsic value is correct, over time an asset's price should converge with its value. What are the companies worth? Eventually, this is what it comes down to. It's not enough to buy a share in a good idea, or even a good business. You must buy it at a reasonable, or, hopefully, a bargain, price. Bubble.com, January 3, 2000. All of this begs the question, what goes into the price? What should a prospective buyer be looking at to be sure the price is right? Underlying fundamental value, of course, but most of the time a security's price will be affected at least as much, and its short-term fluctuations determined primarily by two other factors, psychology and technicals. Most investors, and certainly most non-professionals, know little about technicals. These are non-fundamental factors, that is, things unrelated to value, that affect the supply and demand for securities. Two examples: the forced selling that takes place when market crashes cause levered investors to receive margin calls and be sold out, and the inflows of cash to mutual funds that require portfolio managers to buy. In both cases, people are forced to enter into securities transactions without much regard for price. Believe me, there's nothing better than buying from someone who has to sell regardless of price during a crash. Many of the best buys we've ever made occurred for that reason. A couple of observations are in order, however, you can't make a career out of buying from forced sellers and selling to forced buyers. They're not around all the time, just on rare occasions at the extremes of crises and bubbles. Since buying from a forced seller is the best thing in our world, being a forced seller is the worst. That means it's essential to arrange your affairs so you'll be able to hold on, and not sell, at the worst of times. This requires both long-term capital and strong psychological resources. And that brings me to the second factor that exerts such a powerful influence on price: psychology. It's impossible to overstate how important this is. In fact, it's so vital that several later chapters are devoted to discussing investor psychology and how to deal with its manifestations. Whereas the key to ascertaining value is skilled financial analysis, the key to understanding the price-value relationship, and the outlook for it, lies largely in insight into other investors' minds. Investor psychology can cause a security to be priced just about anywhere in the short run, regardless of its fundamentals. The discipline that is most important is not accounting or economics, but psychology. The key is who likes the investment now and who doesn't. Future price changes will be determined by whether it comes to be liked by more people or fewer people in the future. Investing is a popularity contest, and the most dangerous thing is to buy something at the peak of its popularity. At that point, all favorable facts and opinions are already factored into its price, and no new buyers are left to emerge. The safest and most potentially profitable thing is to buy something when no one likes it. Given time, its popularity, and thus its price, can only go one way, up. Random Thoughts on the Identification of Investment Opportunities, January 24, 1994. Clearly, this is yet another area that is, A, of critical importance and, B, extremely hard to master. First, psychology is elusive. And second, the psychological factors that weigh on other investors' minds and influence their actions will weigh on yours as well. As you will read in later chapters, these forces tend to cause people to do the opposite of what a superior investor must do. For self-protection, then, you must invest the time and energy to understand market psychology. It's essential to understand that fundamental value will be only one of the factors determining a security's price on the day you buy it. Try to have psychology and technicals on your side as well. The polar opposite of conscientious value investing is mindlessly chasing bubbles, in which the relationship between price and value is totally ignored. All bubbles start with some nugget of truth. Tulips are beautiful and rare, in 17th century Holland. The internet is going to change the world. Real estate can keep up with inflation, and you can always live in a house. A few clever investors figure out, or perhaps even foresee, these truths, invest in the asset, and begin to show profits. Then others catch on to the idea, or just notice that people are making money, and they buy as well, lifting the asset's price. But as the price rises further and investors become more inflamed by the possibility of easy money, they think less and less about whether the price is fair. It's an extreme rendition of the phenomenon I described earlier. People should like something less when its price rises. But in investing they often like it more. In 2004 to 2006, for example, people could conjure up only good things about houses and condos, the desirability of participating in the American dream of homeownership, the ability to benefit from inflation, the fact that mortgage loans were cheap and payments would be tax deductible, and ultimately the accepted wisdom that home prices only go up. We all know what happened to that little nugget of wisdom. And what of that other infamous, can't lose idea? In the tech bubble, buyers didn't worry about whether a stock was priced too high because they were sure someone else would be willing to pay them more for it. Unfortunately, the greater fool theory works only until it doesn't. Valuation eventually comes into play, and those who are holding the bag when it does have to face the music. The positives behind stocks can be genuine and still produce losses if you overpay for them. Those positives, and the massive profits that seemingly everyone else is enjoying, can eventually cause those who have resisted participating to capitulate and buy. A top in a stock, group or market occurs when the last holdout who will become a buyer does so. The timing is often unrelated to fundamental developments. Prices are too high is far from synonymous with the next move will be downward. Things can be overpriced and stay that way for a long time or become far more so. Eventually, though, valuation has to matter. Bubble.com, January 3, 2000. The problem is that in bubbles, attractive morphs into attractive at any price. People often say, it's not cheap, but I think it'll keep going up because of excess liquidity, or any number of other reasons. In other words, they say, it's fully priced, but I think it'll become more so. Buying or holding on that basis is extremely chancy, but that's what makes bubbles. In bubbles, infatuation with market momentum takes over from any notion of value and fair price, and greed, plus the pain of standing by as others make seemingly easy money, neutralizes any prudence that might otherwise hold sway. To sum up, I believe that an investment approach based on solid value is the most dependable. In contrast, counting on others to give you a profit regardless of value, relying on a bubble, is probably the least. Consider the possible routes to investment profit, benefiting from a rise in the asset's intrinsic value. The problem is that increases in value are hard to predict accurately. Further, the conventional view of the potential for increase is usually baked into the asset's price, meaning that unless your view is different from the consensus and superior, it's likely you're already paying for the potential improvement. In certain areas of investing, most notably private equity, the buying of companies, and real estate, control investors can strive to create increases in value through active management of the asset. This is worth doing, but it's time-consuming and uncertain and requires considerable expertise. And it can be hard to bring about improvement, for example, in an already good company. Applying leverage. Here the problem is that using leverage, buying with borrowed money, doesn't make anything a better investment or increase the probability of gains. It merely magnifies whatever gains or losses may materialize. And it introduces the risk of ruin if a portfolio fails to satisfy a contractual value test and lenders can demand their money back at a time when prices and illiquidity are depressed. Over the years, leverage has been associated with high returns, but also with the most spectacular meltdowns and crashes. Selling for more than your asset's worth. Everyone hopes a buyer will come along who's willing to overpay for what they have for sale. But certainly the hoped-for arrival of this sucker can't be counted on. Unlike having an underpriced asset move to its fair value, expecting appreciation on the part of a fairly priced or overpriced asset requires irrationality on the part of buyers that absolutely cannot be considered dependable. Buying something for less than its value. In my opinion, this is what it's all about, the most dependable way to make money. Buying at a discount from intrinsic value and having the asset's price move toward its value doesn't require serendipity. It just requires that market participants wake up to reality. When the market's functioning properly, value exerts a magnetic pull on price. Of all the possible routes to investment profit, buying cheap is clearly the most reliable. Even that, however, isn't sure to work. You can be wrong about the current value. Or events can come along that reduce value. Or deterioration in attitudes or markets can make something sell even further below its value. Or the convergence of price and intrinsic value can take more time than you have. As John Maynard Keynes pointed out, the market can remain irrational longer than you can remain solvent. Trying to buy below value isn't infallible, but it's the best chance we have. Chapter 5. The most important thing is understanding risk. Risk means more things can happen than will happen, Elroy Dimson. Investing consists of exactly one thing, dealing with the future. And because none of us can know the future with certainty, risk is inescapable. Thus, dealing with risk is an essential, I think the essential, element in investing. It's not hard to find investments that might go up. If you can find enough of these, you'll have moved in the right direction. But you're unlikely to succeed for long if you haven't dealt explicitly with risk. The first step consists of understanding it. The second step is recognizing when it's high. The critical final step is controlling it. Because the issue is so complex and so important, I devote 3 chapters to examining risk in depth. Why do I say risk assessment is such an essential element in the investment process? There are 3 powerful reasons. First, risk is a bad thing, and most level-headed people want to avoid or minimize it. It is an underlying assumption in financial theory that people are naturally risk-averse, meaning they'd rather take less risk than more. Thus, for starters, an investor considering a given investment has to make judgments about how risky it is and whether he or she can live with the absolute quantum of risk. Second, when you're considering an investment, your decision should be a function of the risk entailed as well as the potential return. Because of their dislike for risk, investors have to be bribed with higher prospective returns to take incremental risks. Put simply, if both a U.S. Treasury note and small company stock appeared likely to return 7% per year, everyone would rush to buy the former, driving up its price and reducing its prospective return, and dump the latter, driving down its price and thus increasing its return. This process of adjusting relative prices, which economists call equilibration, is supposed to render prospective returns proportional to risk. So, going beyond determining whether he or she can bear the absolute amount of risk that is attendant, the investor's second job is to determine whether the return on a given investment justifies taking the risk. Clearly, return tells just half of the story, and risk assessment is required. THIRD, when you consider investment results, the return means only so much by itself, the risk taken has to be assessed as well. Was the return achieved in safe instruments or risky ones? In fixed income securities or stocks? In large, established companies or smaller, shakier ones? In liquid stocks and bonds or illiquid private placements? With help from leverage or without it? In a concentrated portfolio or a diversified one? Surely investors who get their statements and find that their accounts made 10% for the year don't know whether their money managers did a good job or a bad one. In order to reach a conclusion, they have to have some idea about how much risk their managers took. In other words, they have to have a feeling for risk-adjusted return. It is from the relationship between risk and return that arises the graphic representation that has become ubiquitous in the investment world that IT shows a capital market line that slopes upward to the right, indicating the positive relationship between risk and return. Markets set themselves up so that riskier assets appear to offer higher returns. If that weren't the case, who would buy them? The familiar graph of the risk-return relationship is elegant in its simplicity. Unfortunately, many have drawn from it an erroneous conclusion that gets them into trouble. Especially in good times, far too many people can be overheard saying, riskier investments provide higher returns. If you want to make more money, the answer is to take more risk. But riskier investments absolutely cannot be counted on to deliver higher returns. Why not? It's simple, if riskier investments reliably produced higher returns, they wouldn't be riskier. The correct formulation is that in order to attract capital, riskier investments have to offer the prospect of higher returns, or higher promised returns, or higher expected returns. But there's absolutely nothing to say those higher prospective returns have to materialize. The way I conceptualize the capital market line makes it easier for me to relate to the relationship underlying it all. Riskier investments are those for which the outcome is less certain. That is, the probability distribution of returns is wider. When priced fairly, riskier investments should entail higher expected returns, the possibility of lower returns, and, in some cases, the possibility of losses. The traditional risk/return graph is deceptive because it communicates the positive connection between risk and return but fails to suggest the uncertainty involved. It has brought a lot of people a lot of misery through its unwavering intimation that taking more risk leads to making more money. I hope my version of the graph is more helpful. It's meant to suggest both the positive relationship between risk and expected return and the fact that uncertainty about the return and the possibility of loss increase as risk increases. Risk, January 19, 2006. Our next major task is to define risk. What exactly does it involve? We can get an idea from its synonyms: danger, hazard, jeopardy, peril. They all sound like reasonable candidates, and pretty undesirable. And yet, finance theory, the same theory that contributed the risk-return graph and the concept of risk adjustment, defines risk very precisely as volatility, or variability, or deviation. None of these conveys the necessary sense of peril. According to the academicians who developed capital market theory, risk equals volatility, because volatility indicates the unreliability of an investment. I take great issue with this definition of risk. It's my view that, knowingly or unknowingly, academicians settled on volatility as the proxy for risk as a matter of convenience. They needed a number for their calculations that was objective and could be ascertained historically and extrapolated into the future. Volatility fits the bill, and most of the other types of risk do not. The problem with all of this, however, is that I just don't think volatility is the risk most investors care about. There are many kinds of risk. But volatility may be the least relevant of them all. Theory says investors demand more return from investments that are more volatile. But for the market to set the prices for investments such that more volatile investments will appear likely to produce higher returns, there have to be people demanding that relationship, and I haven't met them yet. I've never heard anyone at Oaktree, or anywhere else, for that matter, say, I won't buy it, because its price might show big fluctuations, or I won't buy it, because it might have a down quarter. Thus, it's hard for me to believe volatility is the risk investors factor in when setting prices and prospective returns. Rather than volatility, I think people decline to make investments primarily because they're worried about a loss of capital or an unacceptably low return. To me, I need more upside potential because I'm afraid I could lose money makes an awful lot more sense than I need more upside potential because I'm afraid the price may fluctuate. No, I'm sure risk is, first and foremost, the likelihood of losing money. Risk, January 19, 2006. The possibility of permanent loss is the risk I worry about, Oaktree worries about, and every practical investor I know worries about. But there are many other kinds of risk, and you should be conscious of them, because they can either A. affect you or B. affect others and thus present you with opportunities for profit. Investment risk comes in many forms. Many risks matter to some investors but not to others, and they may make a given investment seem safe for some investors but risky for others. Falling short of one's goal, investors have differing needs, and for each investor the failure to meet those needs poses a risk. A retired executive may need 4% per year to pay the bills, whereas 6% would represent a windfall. But for a pension fund that has to average 8% per year, a prolonged period returning 6% would entail serious risk. Obviously, this risk is personal and subjective, as opposed to absolute and objective. A given investment may be risky in this regard for some people but riskless for others. Thus, this cannot be the risk for which the market demands compensation in the form of higher prospective returns. Underperformance. Let's say an investment manager knows there won't be more money forthcoming no matter how well a client's account performs, but it's clear the account will be lost if it fails to keep up with some index. That's benchmark risk, and the manager can eliminate it by emulating the index. But every investor who's unwilling to throw in the towel on outperformance, and who chooses to deviate from the index in its pursuit, will have periods of significant underperformance. In fact, since many of the best investors stick most strongly to their approach, and since no approach will work all the time, the best investors can have some of the greatest periods of underperformance. Specifically, in crazy times, disciplined investors willingly accept the risk of not taking enough risk to keep up. See Warren Buffett and Julian Robertson in 1999. That year, underperformance was a badge of courage because it denoted a refusal to participate in the tech bubble. Career risk. This is the extreme form of underperformance risk, the risk that arises when the people who manage money and the people whose money it is are different people. In those cases, the managers, or agents, may not care much about gains, in which they won't share, but may be deathly afraid of losses that could cost them their jobs. The implication is clear: risk that could jeopardize return to an agent's firing point is rarely worth taking. Unconventionality. Along similar lines, there's the risk of being different. Stewards of other people's money can be more comfortable turning in average performance, regardless of where it stands in absolute terms, than with the possibility that unconventional actions will prove unsuccessful and get them fired. Concern over this risk keeps many people from superior results, but it also creates opportunities in unorthodox investments for those who dare to be different. Illiquidity: if an investor needs money with which to pay for surgery in 3 months or buy a home in a year, he or she may be unable to make an investment that can't be counted on for liquidity that meets the schedule. Thus, for this investor, risk isn't just losing money or volatility, or any of the above. It's being unable when needed to turn an investment into cash at a reasonable price. This, too, is a personal risk. Risk, January 19, 2006. Now I want to spend a little time on the subject of what gives rise to the risk of loss. First, risk of loss does not necessarily stem from weak fundamentals. A fundamentally weak asset, a less than stellar company's stock, a speculative grade bond, or a building in the wrong part of town, can make for a very successful investment if bought at a low enough price. Second, risk can be present even without weakness in the macro environment. The combination of arrogance, failure to understand and allow for risk, and a small adverse development can be enough to wreak havoc. It can happen to anyone who doesn't spend the time and effort required to understand the processes underlying his or her portfolio. Mostly it comes down to psychology that's too positive and thus prices that are too high. Investors tend to associate exciting stories and pizzazz with high potential returns. They also expect high returns from things that have been doing well lately. These souped-up investments may deliver on people's expectations for a while, but they certainly entail high risk. Having been borne aloft on the crowd's excitement and elevated to what I call the pedestal of popularity, they offer the possibility of continued high returns, but also of low or negative ones. Theory says high return is associated with high risk because the former exists to compensate for the latter. But pragmatic value investors feel just the opposite. They believe high return and low risk can be achieved simultaneously by buying things for less than they're worth. In the same way, overpaying implies both low return and high risk. Dull, ignored, possibly tarnished and beaten down securities, often bargains exactly because they haven't been performing well, are often the ones value investors favor for high returns. Their returns in bull markets are rarely at the top of the heap, but their performance is generally excellent on average, more consistent than that of hot stocks and characterized by low variability, low fundamental risk and smaller losses when markets do badly. Much of the time, the greatest risk in these low-luster bargains lies in the possibility of underperforming in heated bull markets. That's something the risk-conscious value investor is willing to live with. I'm sure we agree that investors should and do demand higher prospective returns on the investments they perceive as riskier. And hopefully we can agree that losing money is the risk people care about most in demanding prospective returns and thus in setting prices for investments. An important question remains: how do they measure that risk? First, it clearly is nothing but a matter of opinion, hopefully an educated, skillful estimate of the future, but still just an estimate. Second, the standard for quantification is non-existent. With any given investment, some people will think the risk is high and others will think it's low. Some will state it as the probability of not making money, and some as the probability of losing a given fraction of their money, and so forth. Some will think of it as the risk of losing money over 1 year, and some as the risk of losing money over the entire holding period. Clearly, even if all the investors involved met in a room and showed their cards, they'd never agree on a single number representing an investment's riskiness. And even if they could, that number wouldn't likely be capable of being compared against another number, set by another group of investors, for another investment. This is one of the reasons why I say risk and the risk/return decision aren't machinable, or capable of being turned over to a computer. Ben Graham and David Dodd put it this way more than 60 years ago in the second edition of Security Analysis, the Bible of Value Investors. The relation between different kinds of investments and the risk of loss is entirely too indefinite and too variable with changing conditions to permit of sound mathematical formulation. THIRD, risk is deceptive. Conventional considerations are easy to factor in, like the likelihood that normally recurring events will recur. But freakish, once-in-a-lifetime events are hard to quantify. The fact that an investment is susceptible to a particularly serious risk that will occur infrequently if at all, what I call the improbable disaster, means it can seem safer than it really is. The bottom line is that, looked at prospectively, much of risk is subjective, hidden and unquantifiable. Where does that leave us? If the risk of loss can't be measured, quantified or even observed, and if it's consigned to subjectivity, how can it be dealt with? Skillful investors can get a sense for the risk present in a given situation. They make that judgment primarily based on A. the stability and dependability of value and B. the relationship between price and value. Other things will enter into their thinking, but most will be subsumed under these two. There have been many efforts of late to make risk assessment more scientific. Financial institutions routinely employ quantitative risk managers separate from their asset management teams and have adopted computer models such as value at risk to measure the risk in a portfolio. But the results produced by these people and their tools will be no better than the inputs they rely on and the judgments they make about how to process the inputs. In my opinion, they'll never be as good as the best investors. Subjective judgments. Given the difficulty of quantifying the probability of loss, investors who want some objective measure of risk-adjusted return, and they are many, can only look to the so-called Sharpe ratio. This is the ratio of a portfolio's excess return, its return above the riskless rate, or the rate on short-term treasury bills, to the standard deviation of the return. This calculation seems serviceable for public market securities that trade and price often. There is some logic, and it truly is the best we have. While it says nothing explicitly about the likelihood of loss, there may be reason to believe that the prices of fundamentally riskier securities fluctuate more than those of safer ones, and thus that the Sharpe ratio has some relevance. For private assets lacking market prices, like real estate and whole companies, there's no alternative to subjective risk adjustment. A few years ago, while considering the difficulty of measuring risk prospectively, I realized that because of its latent non-quantitative and subjective nature, the risk of an investment, defined as the likelihood of loss, can't be measured in retrospect any more than it can a priori. Let's say you make an investment that works out as expected. Does that mean it wasn't risky? Maybe you buy something for $100 and sell it a year later for $200. Was it risky? Who knows? Perhaps it exposed you to great potential uncertainties that didn't materialize. Thus, its real riskiness might have been high. Or let's say the investment produces a loss. Does that mean it was risky? Or that it should have been perceived as risky at the time it was analyzed and entered into? If you think about it, the response to these questions is simple. The fact that something, in this case, loss, happened doesn't mean it was bound to happen, and the fact that something didn't happen doesn't mean it was unlikely. Fooled by randomness, by Nassim Nicholas Taleb, is the authority on this subject as far as I'm concerned, and in it he talks about the alternative histories that could have unfolded but didn't. There's more about this important book in Chapter 16, but at the moment I am interested in how the idea of alternative histories relates to risk. In the investing world, one can live for years off one great coup or one extreme but eventually accurate forecast. But what's proved by one success? When markets are booming, the best results often go to those who take the most risk. Were they smart to anticipate good times and bulk up on beta, or just congenitally aggressive types who were bailed out by events? Most simply put, how often in our business are people right for the wrong reason? These are the people Nassim Nicholas Taleb calls lucky idiots, and in the short run it's certainly hard to tell them from skilled investors. The point is that even after an investment has been closed out, it's impossible to tell how much risk it entailed. Certainly the fact that an investment worked doesn't mean it wasn't risky, and vice versa. With regard to a successful investment, where do you look to learn whether the favorable outcome was inescapable or just one of 100 possibilities, many of them unpleasant? And ditto for a loser, how do we ascertain whether it was a reasonable but ill-fated venture, or just a wild stab that deserved to be punished? Did the investor do a good job of assessing the risk entailed? That's another good question that's hard to answer. Need a model? Think of the weatherman. He says there's a 70% chance of rain tomorrow. It rains, was he right or wrong? Or it doesn't rain, was he right or wrong? It's impossible to assess the accuracy of probability estimates other than 0 and 100 except over a very large number of trials. Risk, January 19, 2006. And that brings me to the quotation from Elroy Dimson that led off this chapter: risk means more things can happen than will happen. Now we move toward the metaphysical aspects of risk. Perhaps you recall the opening sentence of this chapter: investing consists of exactly one thing, dealing with the future. Yet clearly it's impossible to know anything about the future. If we're far-sighted, we can have an idea of the range of future outcomes and their relative likelihood of occurring, that is, we can fashion a rough probability distribution. On the other hand, if we're not, we won't know these things and it'll be pure guesswork. If we have a sense for the future, we'll be able to say which outcome is most likely, what other outcomes also have a good chance of occurring, how broad the range of possible outcomes is, and thus what the expected result is. The expected result is calculated by weighting each outcome by its probability of occurring. It's a figure that says a lot, but not everything, about the likely future. But even when we know the shape of the probability distribution, which outcome is most likely and what the expected result is, and even if our expectations are reasonably correct, we know about only likelihoods or tendencies. I've spent hours playing gin and backgammon with my good friend Bruce Newberg. Our time spent with cards and dice, where the odds are absolutely knowable, demonstrates the significant role played by randomness, and thus the vagary of probabilities. Bruce has put it admirably into words: there's a big difference between probability and outcome. Probable things fail to happen, and improbable things happen, all the time. That's one of the most important things you can know about investment risk. While on the subject of probability distributions, I want to take a moment to make special mention of the normal distribution. Obviously, investors are required to make judgments about future events. To do that, we settle on a central value around which we think events are likely to cluster. This may be the mean or expected value, the outcome that on average is expected to occur, the median, the outcome with half the possibilities above and half below, or the mode, the single most likely outcome. But to cope with the future, it's not sufficient to have a central expectation, we have to have a sense for the other possible outcomes and their likelihood. We need a distribution that describes all of the possibilities. Most phenomena that cluster around a central value, for example, the heights of people, form the familiar bell-shaped curve, with the probability of a given observation peaking at the center and trailing off toward the extremes, or tails. There may be more men of 5 feet 10 inches than any other height, somewhat fewer of 5 feet 9 inches or 5 feet 11 inches, a lot less of 5 feet 3 inches or 6 feet 5 inches, and almost none of 4 feet 8 inches or 7 feet. Rather than enumerating the probability of each observation individually, standard distributions provide a convenient way to summarize the probabilities, such that a few statistics can tell you everything you have to know about the shape of things to come. The most common bell-shaped distribution is called the normal distribution. However, people often use the terms bell-shaped and normal interchangeably, and they're not the same. The former is a general type of distribution, while the latter is a specific bell-shaped distribution with very definite statistical properties. Failure to distinguish between the two doubtless made an important contribution to the recent credit crisis. In the years leading up to the crisis, financial engineers, or quants, played a big part in creating and evaluating financial products such as derivatives and structured entities. In many cases they made the assumption that future events would be normally distributed. But the normal distribution assumes events in the distant tails will happen extremely infrequently, while the distribution of financial developments, shaped by humans, with their tendency to go to emotion-driven extremes of behavior, should probably be seen as having fatter tails. Thus, when widespread mortgage defaults began to occur, events thought to be unlikely befell mortgage-related vehicles on a regular basis. Investors in vehicles that had been constructed on the basis of normal distributions, without much allowance for tail events, some might borrow Nassim Nicholas Taleb's term, black swans, often saw the wheels come off. Now that investing has become so reliant on higher math, we have to be on the lookout for occasions when people wrongly apply simplifying assumptions to a complex world. Quantification often lends excessive authority to statements that should be taken with a grain of salt. That creates significant potential for trouble. Here's the key to understanding risk: it's largely a matter of opinion. It's hard to be definitive about risk, even after the fact. You can see that one investor lost less than another in bad times and conclude that that investor took less risk. Or you can note that one investment declined more than another in a given environment and thus say it was riskier. Are these statements necessarily accurate? For the most part, I think it's fair to say that investment performance is what happens when a set of developments, geopolitical, macroeconomic, company level, technical and psychological, collide with an extant portfolio. Many futures are possible, to paraphrase Dimson, but only one future occurs. The future you get may be beneficial to your portfolio or harmful, and that may be attributable to your foresight, prudence, or luck. The performance of your portfolio under the one scenario that unfolds says nothing about how it would have fared under the many alternative histories that were possible. A portfolio can be set up to withstand 99% of all scenarios but succumb because it's the remaining 1% that materializes. Based on the outcome, it may seem to have been risky, whereas the investor might have been quite cautious. Another portfolio may be structured so that it will do very well in half the scenarios and very poorly in the other half. But if the desired environment materializes and it prospers, onlookers can conclude that it was a low-risk portfolio. The success of a third portfolio can be entirely contingent on one oddball development, but if it occurs, wild aggression can be mistaken for conservatism and foresight. Return alone, and especially return over short periods of time, says very little about the quality of investment decisions. Return has to be evaluated relative to the amount of risk taken to achieve it. And yet, risk cannot be measured. Certainly it cannot be gauged on the basis of what everybody says at a moment in time. Risk can be judged only by sophisticated, experienced second-level thinkers. Here's my wrap-up on understanding risk. Investment risk is largely invisible before the fact, except perhaps to people with unusual insight, and even after an investment has been exited. For this reason, many of the great financial disasters we've seen have been failures to foresee and manage risk. There are several reasons for this. Risk exists only in the future, and it's impossible to know for sure what the future holds. No ambiguity is evident when we view the past. Only the things that happened, happened. But that definiteness doesn't mean the process that creates outcomes is clear, cut and dependable. Many things could have happened in each case in the past, and the fact that only one did happen understates the variability that existed. Decisions whether or not to bear risk are made in contemplation of normal patterns recurring, and they do most of the time. But once in a while, something very different happens. Occasionally, the improbable does occur. Projections tend to cluster around historic norms and call for only small changes. The point is, people usually expect the future to be like the past and underestimate the potential for change. We hear a lot about worst-case projections, but they often turn out not to be negative enough. I tell my father's story of the gambler who lost regularly. One day he heard about a race with only one horse in it, so he bet the rent money. Halfway around the track, the horse jumped over the fence and ran away. Invariably things can get worse than people expect. Maybe worst case means the worst we've seen in the past. But that doesn't mean things can't be worse in the future. In 2007, many people's worst case assumptions were exceeded. Risk shows up lumpily. If we say 2% of mortgages default each year, and even if that's true when we look at a multi-year average, an unusual spate of defaults can occur at a point in time, sinking a structured finance vehicle. It's invariably the case that some investors, especially those who employ high leverage, will fail to survive at those intervals. People overestimate their ability to gauge risk and understand mechanisms they've never before seen in operation. In theory, one thing that distinguishes humans from other species is that we can figure out that something's dangerous without experiencing it. We don't have to burn ourselves to know we shouldn't sit on a hot stove. But in bullish times, people tend not to perform this function. Rather than recognize risk ahead, they tend to overestimate their ability to understand how new financial inventions will work. Finally and importantly, most people view risk-taking primarily as a way to make money. Bearing higher risk generally produces higher returns. The market has to set things up to look like that'll be the case. If it didn't, people wouldn't make risky investments. But it can't always work that way, or else risky investments wouldn't be risky. And when risk-bearing doesn't work, it really doesn't work, and people are reminded what risk's all about. No different this time, December 17, 2007 /. Chapter 6. The most important thing is recognizing risk. My belief is that because the system is now more stable, we'll make it less stable through more leverage, more risk-taking. Myron Scholes. The received wisdom is that risk increases in the recessions and falls in booms. In contrast, it may be more helpful to think of risk as increasing during upswings, as financial imbalances build up, and materializing in recessions. Andrew Crockett. No matter how good fundamentals may be, humans exercising their greed and propensity to err have the ability to screw things up. Great investing requires both generating returns and controlling risk. And recognizing risk is an absolute prerequisite for controlling it. Hopefully I've made clear what I think risk is, and isn't. Risk means uncertainty about which outcome will occur and about the possibility of loss when the unfavorable ones do. The next important step is to describe the process through which risk can be recognized for what it is. Recognizing risk often starts with understanding when investors are paying it too little heed, being too optimistic and paying too much for a given asset as a result. High risk, in other words, comes primarily with high prices. Whether it be an individual security or other asset that is overrated and thus overpriced, or an entire market that's been borne aloft by bullish sentiment and thus is sky high, participating when prices are high rather than shying away is the main source of risk. Whereas the theorist thinks return and risk are two separate things, albeit correlated, the value investor thinks of high risk and low prospective return as nothing but two sides of the same coin, both stemming primarily from high prices. The awareness of the relationship between price and value, whether for a single security or an entire market, is an essential component of dealing successfully with risk. Risk arises when markets go so high that prices imply losses rather than the potential rewards they should. Dealing with this risk starts with recognizing it. All along the upward, sloping capital market line, the increase in potential return represents compensation for bearing incremental risk. Except for those people who can generate alpha or access managers who have it, investors shouldn't plan on getting added return without bearing incremental risk. And for doing so, they should demand risk premiums. But at some point in the swing of the pendulum, people usually forget that truth and embrace risk-taking to excess. In short, in bull markets, usually when things have been going well for a while, people tend to say, "Risk is my friend. The more risk I take, the greater my return will be. I'd like more risk, please." The truth is, risk tolerance is antithetical to successful investing. When people aren't afraid of risk, they'll accept risk without being compensated for doing so, and risk compensation will disappear. This is a simple and inevitable relationship. When investors are unworried and risk-tolerant, they buy stocks at high price/earnings ratios and private companies at high multiples of EBITDA, cash flow, defined as earnings before interest, taxes, depreciation and amortization, and they pile into bonds despite narrow yield spreads and into real estate at minimal cap rates, the ratio of net operating income to price. There are few things as risky as the widespread belief that there's no risk, because it's only when investors are suitably risk-averse that prospective returns will incorporate appropriate risk premiums. Hopefully in the future, A. Investors will remember to fear risk and demand risk premiums, and B. Will continue to be alert for times when they don't. So much that's false and nutty. July 8, 2009. So a prime element in risk creation is a belief that risk is low, perhaps even gone altogether. That belief drives up prices and leads to the embrace of risky actions despite the lowness of prospective returns. In 2005 to 2007, belief that risk had been banished caused prices to rise to bubble levels and investors to participate in what later turned out to be risky activities. This is one of the most dangerous of all processes, and its tendency to recur is remarkable. Of the many fairy tales told over the last few years, one of the most seductive, and thus dangerous, was the one about global risk reduction. It went this way: the risk of economic cycles has been eased by adroit central bank management. Because of globalization, risk has been spread worldwide rather than concentrated geographically. Securitization and syndication have distributed risk to many market participants rather than leaving it concentrated with just a few. Risk has been tranched out to the investors best able to bear it. Leverage has become less risky because interest rates and debt terms are so much more borrower-friendly. Leveraged buyouts are safer because the companies being bought are fundamentally stronger. Risk can be hedged through long/short and absolute return investing or the use of derivatives designed for that purpose. Improvements in computers, mathematics, and modeling have made the markets better understood and thus less risky. An apt metaphor came from Pension and Investments, August 20, 2007. Jill Fredston is a nationally recognized avalanche expert. She knows about a kind of moral hazard risk, where better safety gear can entice climbers to take more risk, making them in fact less safe. Like opportunities to make money, the degree of risk present in a market derives from the behavior of the participants, not from securities, strategies, and institutions. Regardless of what's designed into market structures, risk will be low only if investors behave prudently. The bottom line is that tales like this one about risk control rarely turn out to be true. Risk cannot be eliminated, it just gets transferred and spread. And developments that make the world look less risky usually are illusory, and thus in presenting a rosy picture they tend to make the world more risky. These are among the important lessons of 2007. Now it's all bad. September 10, 2007. The risk is gone myth is one of the most dangerous sources of risk, and a major contributor to any bubble. At the extreme of the pendulum's upswing, the Belief that risk is low and that the investment in question is sure to produce profits intoxicates the herd and causes its members to forget caution, worry, and fear of loss, and instead to obsess about the risk of missing opportunity. The recent crisis came about primarily because investors partook of novel, complex and dangerous things, in greater amounts than ever before. They took on too much leverage and committed too much capital to illiquid investments. Why did they do these things? It all happened because investors believed too much, worried too little and thus took too much risk. In short, they believed they were living in a low-risk world. Worry and its relatives, distrust, skepticism and risk aversion, are essential ingredients in a safe financial system. Worry keeps risky loans from being made, companies from taking on more debt than they can service, portfolios from becoming overly concentrated, and unproven schemes from turning into popularmanias. When worry and risk aversion are present as they should be, investors will question, investigate, and act prudently. Risky investments either won't be undertaken or will be required to provide adequate compensation in terms of anticipated return. But only when investors are sufficiently risk-averse will markets offer adequate risk premiums. When worry is in short supply, risky borrowers and questionable schemes will have easy access to capital, and the financial system will become precarious. Too much money will chase the risky and the new, driving up asset prices and driving down prospective returns and safety. Clearly, in the months and years leading up to the crisis, few participants worried as much as they're supposed to. Touchstone's November 10, 2009 investment risk comes primarily from too high prices, and too high prices often come from excessive optimism and inadequate skepticism and risk aversion. Contributing underlying factors can include low perspective. Returns on safer investments, recent good performance by risky ones, strong inflows of capital, and easy availability of credit. The key lies in understanding what impact things like these are having. The investment thought process is a chain in which each investment sets the requirement for the next. Here's how I described the process in 2004. I'll use a typical market of a few years back to illustrate how this works in real life. The interest rate on the 30-day T-bill might have been 4%. So investors say, if I'm going to go out 5 years, I want 5%. And to buy the 10-year note I have to get 6%. Investors demand a higher rate to extend maturity because they're concerned about the risk to purchasing power, a risk that is assumed to increase with time to maturity. That's why the yield curve, which in reality is a portion of the capital market line, normally slopes upward with the increase in asset life. Now let's factor in credit risk. If the 10-year Treasury pays 6%, I'm not going to buy a 10-year single, a corporate unless I'm promised 7%. This introduces the concept of credit spreads. Our hypothetical investor wants 100 basis points to go from a govie to a corporate. If the consensus of investors feels the same, that's what the spread will be. What if we depart from investment-grade bonds? I'm not going to touch a high-yield bond unless I get 600 over a Treasury note of comparable maturity. So high-yield bonds are required to yield 12% for a spread of 6% over the Treasury note, if they're going to attract buyers. Now let's leave fixed income altogether. Things get tougher, because you can't look anywhere to find the prospective return on investments like stocks. That's because, simply put, their returns are conjectural, not fixed. But investors have a sense for these things. Historically, S&P stocks have returned 10%, and I'll buy them only if I think they're going to keep doing so. And riskier stocks should return more. I won't buy on the Nasdaq unless I think I'm going to get 13%. From there it's onward and upward. If I can get 10% from stocks, I need 15% to accept the illiquidity and uncertainty associated with real estate. And 25% if I'm going to invest in buyouts and 30% to induce me to go for venture capital, with its low success ratio. That's the way it's supposed to work, and in fact I think it generally does, although the requirements aren't the same at all times. The result is a capital market line of the sort that has become familiar to many of us: return money market, 4%. 5-year Treasury, 5%. 10-year Treasury, 6%. High-grade bonds, 7%. S&P stocks, 10%. High-yield bonds, 12%. Small stocks, 13%. Real estate, 15%. Buyouts, 25%. Venture capital, 30%. Risk 052. Recognizing risk. A big problem for investment returns today stems from the starting point for this process. The riskless rate isn't 4%, it's closer to 1%. Typical investors still want more return if they're going to accept time risk, but with the starting point at 1+%, now 4% is the right rate for the 10-year, not 6%. They won't go into stocks unless they get 6 to 7%. And junk bonds may not be worth it at yields below 7%. Real estate has to yield 8% or so. For buyouts to be attractive, they have to appear to promise 15%, and so on. Thus, we now have a capital market line like the one shown in figure 6.2, which is A, at a much lower level, and B, much flatter. The lower level of the line is explained by the low interest rates, the starting point for which is the low riskless rate. After all, each investment has to compete with others for capital, but this year, due to the low interest rates, the bar for each successively riskier investment has been set lower than at any time in my career. Not only is the capital market line at a low level today in terms of return, but in addition a number of factors have conspired to attain it. Is important, because the slope of the line, or the figure 6.25-year Treasury, 3%. Risk-return money market, 1%. 10-year Treasury, 4%. High-grade bonds, 5%. S&P stocks, 6 to 7%. High-yield bonds, 7%. Small stocks, 7 to 8%. Real estate, 8%. Buyouts, 15%. Venture capital, 20%. 0. Recognizing risk. 53. Extent to which expected return rises per unit increase in risk. Quantify the risk premium. First, investors have fallen over themselves in their EFF or to get away from low-risk, low-return investments. Second, risky investments have been very rewarding for more than 20 years and did particularly well in 2003. Investors are attracted more, or repelled less, by risky investments than perhaps might otherwise be the case, and require less risk compensation to move to them. Investors perceive risk as being quite limited today. In summary, to use the words of the quants, risk aversion is down. Somehow, in that alchemy unique to investor psychology, I wouldn't touch it at any price, had morphed into, looks like a solid investment to me. Risk and return today, October 27, 2004. Is richening process eventually brings on elevated price/earnings ratios, narrow credit spreads, undisciplined investor behavior, heavy use of leverage and strong demand for investment vehicles of all types. Just as these things raise prices and reduce prospective return, they also create a high-risk environment. Risk is incredibly important to investors. It's also ephemeral and unmeasurable. All of this makes it very hard to recognize, especially when emotions are running high. But recognize it we must. In the passage that follows, written in July 2007, I take you through the evaluation process we used at Oaktree to gauge the investment environment and the risk mood at the time. In other time periods the specifics might be different, but I hope this example of the thought process will be useful. Where do we stand today, mid-2007? In my opinion, there's little mystery. I see low levels of skepticism, fear and risk aversion. Most people are willing to undertake risky investments, often because the promised returns from traditional, safe investments seem so meager. This is true even though the lack of interest in safe investments and the acceptance of risky investments have rendered the slope of the risk/return line quite flat. Risk premiums are generally the skimpiest I've ever seen, but few people are responding by refusing to accept incremental risk. Markets have tended recently to move up on positive developments and to recover easily from negatives. I see few assets that people are eager to get rid of, and few forced sellers. Instead, most assets are strongly bid for. As a result, I'm not aware of any broad markets that I would describe as underpriced or uncrowded. It is what it is. We've been living in optimistic times. The cycle has been swinging strongly upward. Prices are elevated and risk premiums are slender. Trust has replaced skepticism, and eagerness has replaced reticence. Do you agree or disagree? That's the key question. Answer it first, and the implications for investing become clear. In the first quarter of this year, significant delinquencies occurred in subprime mortgages. Those directly involved lost a lot of money, and onlookers worried about contagion to other parts of the economy and other markets. In the second quarter, the impact reached CDOs or collateralized debt obligations, structured, tranched investing entities that had invested in subprime mortgage portfolios, and hedge funds that had bought CDO debt, including two Bear Stearns funds. Those who had to liquidate assets were forced, as usual in tough times, to sell what they could sell, not what they wanted to sell, and not just the offending subprime-linked assets. We began to read about ratings downgrades, margin calls and fire sales, the usual fuel for capital market meltdowns. And in the last few weeks we've begun to see investor reticence on the rise, with new low-grade debt issues repriced, postponed or pulled, leaving bridge loans unrefinanced. The last 4.5 years have been carefree, halcyon times for investors. That doesn't mean it'll stay that way. I'll give Warren Buffett the last word, as I often do. It's only when the tide goes out that you find out who's been swimming naked. Pollyannas take note, the tide cannot come in forever. It's all good. July 16, 2007. I want to point out emphatically that none of the comments in the July 2007 memo, and none of my other warnings,